For many individuals, the stock market appears puzzling, remote, or even daunting. When people hear stock market, they often visualize complex graphs, quick decisions, and significant risks being taken. They envision experts glued to screens, responding to numbers that shift every moment. This perception leads many to believe the stock market isn't for them. Some equate it to gambling. Others view it as exclusive to wealthy individuals. Many also feel that it's impossible to grasp without a finance or economics background. However, the reality is much more straightforward. The stock market is not inherently complex. It feels that way primarily because it isn't often explained gradually and clearly. This video targets those with minimal financial knowledge. There's no pressure involved. Everything shared here is not advice. There's no need for any immediate action. The primary aim is comprehension. Before diving into the stock market, we ought to consider money itself. Money serves as a tool. It empowers individuals to exchange value, save for the future, and create over time. In daily life, money is used to cover housing costs, purchase food, access various services, and save for future needs. When people save money, they often associate it with safety. Holding cash or placing it in a bank account feels secure. It appears predictable. However, there's a crucial concept that many don't learn early on. Over lengthy periods, money doesn't maintain equal value. Inflation indicates that prices gradually rise over time. What costs a specific amount today may be more expensive in the future. This increase doesn't occur suddenly. It happens step by step, year after year. As inflation progresses, the same amount of money buys less in the future than it does now. This doesn't imply cash is detrimental. It highlights cash's limitations. Grasping inflation clarifies why people seek ways to enhance their money rather than just saving. This is where the stock market comes into play. Every business requires funding. Initially, a business might start small. It may utilize personal savings or small loans. However, as a business expands, its requirements grow. It may need funding to develop innovative products, hire additional employees, purchase superior equipment, and expand into new markets. At this stage, businesses face options. They can incur debt by borrowing money. Alternatively, they might sell a portion of their ownership. Many businesses opt to sell ownership. This choice is one reason for the stock market's existence. Ownership signifies having a stake in something. When you possess part of a company, you're involved in its future. This doesn't mean you manage the company. You don't make daily decisions. It simply signifies that your financial outcome correlates with the company's performance. If the company thrives and gains value, your ownership often appreciates as well. If the company faces difficulties, your ownership might decline in value. This shared result is the core principle of investing. A stock is a fractional ownership unit. Companies break ownership into smaller parts called shares. When someone acquires a share, they gain a small piece of the company. Stocks are neither forecasts nor promises. They are simply units of ownership. Their value fluctuates as businesses change and as expectations shift. This explains price movements even when significant events do not occur. The stock market serves as a marketplace. It's where individuals buy and sell company ownership. It doesn't determine value directly. Instead, it mirrors what people believe at that moment. Prices rise when demand to buy increases. Prices drop when more people seek to sell. This fluctuation may feel chaotic, particularly in the short term. However, Over extended periods, prices typically reflect overall business performance and economic development. Most individuals invest to increase their funds over the long haul. They don't aim to predict future outcomes. They aren't looking to act in haste. Instead, they seek to align their savings with economic progress. As businesses grow and innovate, their value may enhance. Investing enables people to share in that growth. This process requires time. Years are more significant than days. It's crucial to distinguish between two concepts. Investing emphasizes long-term ownership. Trading focuses on short-term price fluctuations. Most individuals benefiting from the stock market over time are investors. They accept price volatility. They prioritize long-term trends rather than short-term disturbances. Time becomes their advantage. Market movements occur because people react to information, uncertainty, and emotions. Fear and hope shape their choices. Short-term shifts are often driven by emotions. Long-term movements are based on structural factors. Recognizing this distinction can alleviate anxiety and confusion. Risk is present in every financial system. The aim is not to evade risk entirely. The goal is to comprehend it. Diversifying by owning many companies minimizes risk. This concept is called diversification. Diversification doesn't eliminate uncertainty, but it lessens reliance on a single outcome. The stock market isn't a shortcut. It's not a guaranteed path to wealth. It serves as a tool to reflect business and economic evolution. You don't need to rush into action. It's not necessary to know everything at once. Understanding is the first step. Confidence will follow later. To genuinely grasp the stock market, it helps to step back and appreciate the broader perspective. The stock market isn't separate from daily life. It exists because businesses operate, people work, and economies advance over time. Every product you use and every service you depend on originated as an idea that required resources to thrive. Money is one of those essential resources. When individuals invest in the stock market, they are not merely gambling on numbers. They are engaging in a growth system. This involvement may initially seem abstract, as ownership is indirect. You won't see factories. You aren't attending board meetings. You won't make operational decisions. Yet ownership is still present. If a business consistently delivers value to customers, this value will typically reflect in its long-term outcomes. That's why the stock market is generally discussed in decades rather than days. Short-term fluctuations draw attention, yet they don't define the overall system. Another key notion for beginners is recognizing expectations. Stock prices shift not only due to actual events. They fluctuate based on changing expectations. If a company excels but not as anticipated, prices might decrease. If a company underperforms yet surpasses expectations, prices may rise. This can be perplexing, but it emphasizes an essential truth. The stock market reflects human expectations, not only outcomes. This is why emotions heavily influence short-term price movements. Fear, enthusiasm, uncertainty, and confidence all impact decision-making. However, over extended periods, these emotions generally balance out. What remains are the fundamentals: businesses generating value, economies expanding, and productivity growing. This is why long-term investors concentrate less on daily updates and focus more on broader trends. Another concept that beginners frequently grapple with is patience. The stock market rewards time over intellect. It favors consistency over speed. Attempting to act quickly often leads to errors, particularly for newcomers. Being a slow learner isn't a disadvantage. It can be an asset. Many individuals experience pressure to take action after learning about the stock market. However, learning doesn't necessitate immediate action. You can observe. You can research. You can develop understanding without exposure to risk. This point is often neglected, yet it's vital. The stock market will still exist tomorrow. It will still be there next year. There's no finish line. For beginners, the most crucial outcome is not immediate participation, but clarity. Clarity about the stock market's nature. Clarity regarding what it isn't. And clarity about how it intertwines with the real economy. Once understanding is achieved, evaluating everything else becomes much simpler.